Alex, I'm passing host over to you, so just please manage the waiting room if people join. Okay, so I want to cover two things right now. One is the concept of prime setups, and the other one is to do with Wyckoff theory and a little bit of a variation. So for now, for the time being, what I prefer everybody to be doing is simply identifying a supply zone, wait for price to come into that supply zone, and Alex mentioned the break of structure stuff, waiting for an entry off an IFC, that's standard stuff, or a distribution. So we're coming into a supply zone, we see that distribution playing out, etc. If that's the UTAD, enter on the test. That's a very, very simple basis, and that's what you should be doing in the beginning because you know that it is a distribution schematic. We know that happens for a reason. It's not like an IFC where one institution, one bank is funding that candle. Now we have a conversion of all of the things we mentioned before, where demand is going into supply, whereas multiple institutions putting in multiple, millions and millions of lots by multiple institutions, all with the same objective to have some sort of push down. Now, if they're going to all of that time, effort, and energy, and all of that money to distribute in the first place, we know their intentions is not 10 pips. We know that it's going to be a significant move. So, if you're trading with a distribution or with an accumulation, you're likely to get a decent size move. And if you can actually get your precision with your entry, you can get a big move with a small stop loss. That's therefore how you maximize your risk to reward. So we taught that last time, and we went into that in some detail, in great detail from a theory perspective. Today, we're going to show you some actual examples and break them down. But I want to teach you guys reaccumulation and redistribution. Now, for those that don't know, when you enter obviously there's only two phases in the market. You have expansion. This is also expansion. Expansion is simply when the market is trending, when you're moving with purpose. Now, when you're in consolidation, consolidation is simply horizontal movement. We're moving laterally as opposed to moving with intent. So when you're consolidating, what is essentially happening is, as I discussed last time in the Wyckoff block, that buyers and sellers are interacting, and it's reached a point where buyers have come to a point in the market where they are taking profit, and because it's a higher price point, that is where sellers are entering the market. So as we spoke about with the momentum which plays a part, if you're seeing a big impulse, shallow retracement, big impulse, slightly deeper retracement, big impulse, even deeper retracement, impulse, and then 100% retracement. What is that telling you? It's telling you that the market is rounding off like this. That indicates to us that sellers are increasing at every point because we're getting a deeper retracement, and buyers are exiting the market because they are taking profit. So that is kind of the interaction between supply and demand. And obviously that's just simple economics of supply and demand, that the higher the price point, supply and demand changes. So when we enter a zone of consolidation, now we are moving like this. And why are we moving like that? Because sellers are coming in because it's a good price point, and buyers are exiting because they're taking profit. And if the market wants to continue, what do buyers have to do? Buyers have to be in strength, right? If you want to break this resistance or break that range that is consolidating in, we need to know that the sellers that are coming into the market, because it is a better value, they are getting price at a premium, therefore a greater potential for profit. If buyers are to take control, they need to overpower those sellers. So what do they need to do? They need to, like accumulation where supply turns into demand, that's accumulation. What are they doing? The buyers are taking up sell orders. Same for a reaccumulation where buyers are taking up sell orders. So they're taking sellers out of the market. So that's simply, so think of this like a conversion machine over here. We're converting supply into demand. Now, reaccumulation is, I'm going to clean this up a little bit. So accumulation is supply into demand. Reaccumulation is demand into further demand. and you're negating supply. That's the whole idea of when you have consolidation to turn into a reaccumulation, where the market is picking up those orders again, and institutions are now having to put in multiple institutions having to put in multiple millions of lots to overcome the selling pressure and continue that bullish expansion or bullish trend. That is what a reaccumulation is. Now, if you are to look, if you Google Wyckoff reaccumulation or redistribution, you're going to get a lot of charts and a lot of theory of how they should look in the textbook, but in reality, it's not very applicable, and it very rarely comes as the theory states, as the textbook example. It's not easy to find those kind of examples. So what we did was, essentially, because I didn't trade reaccumulation or redistribution for a very long time, because I couldn't find examples that were looking like the textbook, or when I found an example, I didn't know how to trade it because there was not enough confidence. For example, if the market is doing this, if you're here in the market right now, what are the potential outcomes? This can be your UT, UTAD test. That is one option. But your alternative option is this. And then this is your shakeout. That becomes your IFC. So this is test to go bullish. IFC of the UTAD, test to go bearish. So when you're in a scenario where you don't have, in hindsight, you can see it's obvious because you see the spring, or you see the UTAD or the shakeout, whatever you want to call it, and then you see the test, and then you see it play. In hindsight, it's very obvious. But if you're here in prices and this is all the information you have, you don't really know if it's accumulating. You don't know if it's reaccumulating or distributing. So therefore, you need. And then if you look at the textbook, just on the first half, just on the first half of the schematic, if you are to look at the textbook version, it's going to look the same, and you won't be able to differentiate it based on the first half. So we need to actually come up with a set of rules to know if we're trading reaccumulation or trading a distribution, and what kind of things can we foresee for it to be justified. Now, this is where it becomes a bit different, where it's a difference between what we can trade and what we can understand. In hindsight, you will be able to understand most of it, but that does not mean everything you understand is something that is worth trading, because we're here to trade things that are probable, favorable, and that make sense, that are logical. They're not just risk. So that's where the discrepancy comes. So you'll be able to see a lot of reaccumulations playing, but you will not be able to take all of those reaccumulations because it is not worth the risk, because it is not justified unless it meets certain criteria. So before I teach you the criteria, I'm going to show you the logic of why we created those criteria. So you're gonna have to follow my logic. The market is trending. We're in an expansion phase. Now, supply is increasing and demand is reducing because prices got to a higher point. Buyers are taking profit. Sellers are coming into the market. So therefore, you're naturally going to get these deeper retracements, like so. And now the market enters a consolidation phase. So let's say this is our preliminary supply. This is our buying climax. You might have an ST first. That's just a test. That doesn't mean much. You might have a UT. And this is with anticipation that it is distributing. So what would you foresee at this point? You'd foresee a UTAD, test, sign of weakness, etc. That's what you'd anticipate if it was distributing. But at this point, you don't know what it's doing. You just know you can either read it as we have a high, higher, low, higher, higher, low, higher, high. We're still in bullish structure. We can't really be anticipating the sell. It's too early to say. It's too early to say if it's a distribution. It's too early to say if it's even a schematic. And it's too early to say if it's reaccumulating to be bullish. So at this point, we are just monitoring, because this is where you can take losses. Because if I'm to sit and count, if you're just always looking for a schematic, you're going to make a lot of mistakes. Why? Because you could say, oh, this is my preliminary supply. This is my buying climax. This is my UT. This is my UTAD. Therefore, I should wait for a test, and you'll look for that. But if you are misreading the schematic, all you're going to see is the real UTAD, and then you get screwed that way. So it's not about guessing where the schematic is. It's not just guessing points and saying, oh, that looks like a UTAD, oh, that looks like a UT, and just hoping that these drives are actually part of a schematic. That's where you're going to take a lot of losses, and that's initially what most people have problems with when it comes to trading Wyckoff theory. And a lot of our students, to be fair, in the beginning, in the early weeks and months, you're going to be making that mistake a lot because it's a new concept. You're ready to apply it. You think you understand it, and therefore you're going to trying to be forcing it into scenarios where it is not really happening. And that's where you're becoming too eager for the setup. So what you need to do is have rules in place, have the wisdom in place of trying to understand the logic behind the setup or behind the schematic. Okay, so let's leave it like this for now, where we can assume this is our consolidation range. We've entered that consolidation range, and we are starting to, we can at this point say, maybe we're distributing the early signs of distribution, or we are still trending, but we are losing momentum. We can't say for now. But when price continues and we see the UT happening, we might even see the UTAD. That can happen one variation. You see the UTAD. But when the UTAD happens, we have a break of structure of this point over here. A break of structure, I used to think was an amazing sign because as everything we've been taught so far, if we are seeing distribution, and it looks valid, then we see break of structure. This is a bearish sign. Break of structure is also a bearish sign. So for me, it became a double confirmation that, okay, we've had this break of structure now. Now we're golden for the sell. Now the buys don't make setup because we've had a break of structure, and now that bullish market is changing, and we've had a distribution play out. So now that is looking like a very strong sell. So what would I do in this situation? I'll be like, okay, perfect. I just simply need to find my zone of interest in the UTAD. I find my IFC. I set my limits. I jump into the lower time frame. I'll try and understand in that lower time frame. Inside the UTAD, am I seeing some sort of equal highs FU candle like that? So now I would refine my entry even further and say, this is my true IFC. My entry is over here, etc. As we know, to refine your entry. Or I'll talk about the momentum trend line later, but essentially what I'll do is, okay, I've had that break of structure. I know it needs to mitigate my UTAD, so I'd be looking for this setup. And I'll be like, okay, this makes a lot of sense because now I have the distribution, now I have the lower time frame confirmation, now I have the break of structure as my final confirmation. And that's something I did quite often. If you want to backtest examples of me doing this wrong, just write this down for now, and then we'll go over it later. CJ, approximately, it was November, and it was EA January 2020. These two trades I gave as like signals on my public Telegram, or not even signals. I was tracking it live, and I was like, okay, it looked like a very clean distribution on CAD JPY around November time. You'll be able to find it. Just type in CAD JPY or CJ in the search bar, and you'll see all the examples around November time. And Euro AUD around January time this year, just search Euro AUD or EA in the search bar. You'll see the example. And essentially, I was seeing exactly what I'm explaining now, where I had a distribution. It was in a daily supply zone. So that's one tick. We're in a supply zone. We should be looking for sells. Number two, we were seeing a distribution playing out, and it looked very textbook. Number three, we had the break of structure. So therefore, I was simply entering on the test phase. So in hindsight, at the time, that looked like a perfect situation. And what happened on both of these occasions, and I have a lot more examples. Instead of doing that, it would go on to do something like this. So bullish IFC. Again, this having a bullish mitigation does not necessarily mean the sell is invalid, because you can have bullish price action leading into a sell. That's completely fine. So that was not that's not an indication of negating my distribution schematic, because for price to push up, even if it's just for a retracement, even if it's just a complex pullback, whatever it may be, you can still have bullish order flow. You can still have bullish price action. You can still have bullish, healthy price action. That's not an issue. But I'd see this, and now I enter the sell because it's in my supply zone, it's in my IFC of the UTAD, etc. And instead of it doing the big sell I'm looking for, etc., what would happen instead is I'd get a reaction. Why would I get a reaction? Because it's a healthy IFC if it's valid, and the lower time frame confirms it. So at this point, I can catch a small reaction and I break even. That's fine. Or if I didn't manage to break even, obviously I'm going to get a stop loss. But if I'm unsure, this has happened to me many times as well. If I'm unsure because I don't know if it's a true supply zone, I don't know if I want to take the sell, etc., what you can do is, in an area of doubt, say for example on the 4 hour, my IFC is this big, and on the 1 hour, my IFC is this big, and on the 15-minute, I have an IFC over here, I have an IFC over here, and I have an IFC over here. Basically saying I have multiple points of interest, and I don't know which one to put my limit on. That's the whole idea of the momentum trend line. When you're in an area of doubt, don't just set limits and hope. Rather, follow price action live on the 1 minute, 3 minute, 5 minute, 15 minute. From a basics perspective, what I will actually do in reality is I'm going to look at the 1 minute, 2 minute, 3 minute, 4 minute, 5 minute, all the way up, every single time frame up to 15 minutes. And I'm going to be constantly monitoring what each time frame is saying. And I'm going to be constantly updating my momentum trend line. So if I see this, it's broken my momentum trend line technically, but it has respected this momentum trend line. And then I'll continue to watch that, etc., etc. And what you're looking for is when you, with your momentum trend line, because I know Alex explained all of its functions, but you have to realize on a live chart, it is extremely difficult because you're going to be very confused of what is a break of structure, because it might break structure on a 1 minute time frame and therefore break your momentum trend line on the 1 minute, but on the 5 minute, it might respect bullish price action. What do I mean by that? This is your 5 minute swing point. Now the red is your 1 minute time frame. If you're right here, this is your 1 minute momentum trend line. Clearly, you've had a breach of that 1 minute momentum trend line. So you can say 1 min break of structure, right? That is technically a 1 minute break of structure, but price might do this. So now you're thinking, okay, it's respected my 5 minute structure, but it has broken the 1 minute structure. And now you'll be confused because it's happened to me many times. This is your momentum trend line. This is your relevant 1 minute IFC that led to the break in structure of 1 minute. Do you enter on a mitigation? Are you looking for that because your 1 minute momentum trend line broke? Or are you anticipating that because it respected my 5 minute structure, had a mitigation here? Are you expecting this? That's how you get confused with the momentum trend line. So to counteract that, what you need to be doing is following price action. That's why I say look at multi time frames. Look at all of the time frames and see what every single time frame is doing. And what you need to do is when you're in your point of interest, when you're within this range, you need to be seeing not just a small break of structure like this, but you need to see a convincing break of structure so that you can conclusively say it broke all of my momentum trend lines. 1 minute, 5 minute, 3 minute, 7 minute, etc., etc. It is a convincing drop that breaks multiple time frames structure and leaves imbalances. Because then you can say, okay, I had a significant rejection at this point that led to significant breaking structure, and because of the imbalances, that showed intent because institutional money came in. That's how you really want to be taking the momentum trend line trade. So now coming back to this distribution example, we have seen, I'm going to erase a bit because it's getting a bit crowded. Okay, so we're looking to enter on a test of the UTAD based on the IFC inside the UTAD. That all makes sense. Now, because we, for whatever reason, have some doubts, we're not going to enter directly, but we're going to enter on a momentum trend line. We can do that. Now, when we see that convincing break in structure, convincing break of our momentum trend lines, we look at the area that caused that break. That becomes our relevant IFC. So now we enter on a lower time frame of like this, and then we anticipate the sell. So therefore, our stop loss is here. That's how we would enter based on that. Now, the problem being is you can have this as a regular IFC, and this as a regular mitigation, and this zone as a regular mitigation, and this IFC based on the momentum trend line as a valid point of interest. So you're getting multiple reasons to sell: supply zone, reaction, lower time frame confirmation. Therefore, your entry is valid. But you can have that reaction and then still respect bullish price action. You can still come down here, have a mitigation, and then go back to being bullish. At that point, you can break even, not a problem. But you were wrong in the whole directional bias. And then you'll be a bit confused. You'll be like, okay, I followed all of the things I was going to. Okay, I didn't take a loss, but you still need to understand, just because you didn't take a loss does not mean that's fine. You need to understand, okay, I didn't take a loss, but why did it not go in my favor when I had a lot of things when I had a lot of things telling me it was a sell? You had the distribution potentially, you had the break in structure, you had the lower time frame confirmation with all the things I've just discussed. Why was it not a sustained sell? Why did it just give a short-term sell until my bullish structural point and then continue being a buy? That's what I'm going to try and discuss with reaccumulations. But so far on that basis, because we've discussed this before, did all of that make sense on how to enter based on the distribution? Let me just jump back to the chat. Claro. Okay, so devil's advocate is exactly what I'm doing right now. I'm trying to explain we're having a reaccumulation, but the devil's advocate situation is I'm seeing a sell based on the distribution, based on the break of structure, based on the momentum trend line, etc., etc., etc. Why is it not a buy still? I'm trying to explain the sell as the devil's advocate right now. Just a complex pullback, exactly. Thank you, Justin, for 26 January, CJ. Cool. Okay, now I'm going to come to a fresh page because that was messy. I'm going to draw out the same thing. Bullish price action, expansion. We enter now deeper retracements, and we are starting to move. Same situation. Now, if price does this, so my equal lows is sustained. My equal lows is still respected. I am more comfortable in taking that sell. Logically speaking, why? I'm happier to take that sell. Why? Because not only do I have the distribution telling me so, and then I have that UTAD. Now remember, the UTAD can be even more convincing when it's like this. I'm not lining this up correctly. Yeah. This is where smart money and Wyckoff theory overlaps, which is why we have hybridized it in this way. From a Wyckoff perspective, this is still a valid schematic. This is just a different type of schematic, but all of the points are valid of the schematic. But what can we see from our smart money teachings? We can see equal highs, FU candle. Therefore, the test phase of the schematic is actually a mitigation of the FU candle. This is where the two schools of thought overlap. And where is the again the overlap? This is your AR from a Wyckoff perspective. This is your AR. This is the base of your range. This is where you're supposed to have that consolidation before the break, so sign of weakness. That is what Wyckoff theory would state. What does smart money state? We have equal lows over here. That equals a liquidity target. That is where price is attracted to. So both of them are saying the same things. Equal highs, FU test, or schematic UTAD test with equal low targets. Both are very similar things, but they have an overlap. But if those things are respected, mainly speaking the equal lows, that is more favorable. I'll explain why. Actually, yes, I'll do it in red so you guys can see. If this has happened so far, if you're at this point in time, you have seen a lower low. Oh, sorry, you're seeing a higher low relative to this, and then you're seeing a lower high relative to this, and therefore you have that left unmitigated, that area. You have some sort of imbalance or whatever. Now, when price comes here, and you see this, equal low here relative to each other. Right now, from a structural point of view, you're in a mixed situation. You are seeing bearish signs from the low lows and low highs, but you're also seeing bullish signs, and then you're seeing equal low, which is inconclusive. Now you don't know which one to trade. So in this situation, you don't stick to this time frame. You zoom out and you say, okay, what is the greater picture telling me? The greater picture is telling me that I have equal lows and I have an FU candle or a UTAD, whatever you want to call it. Therefore, and this has been unmitigated, therefore price is ideally wanting to come back here. So if we follow structure from that perspective and price does this, what have we seen? We have seen, okay, I'm going to do some highlighting. We've seen lower high, and then we see relative to this. Actually, let's leave it there. Sorry, I've done that wrong. Higher low, and then over here, higher high area. So right now, structure makes sense because we've turned bullish from this, and we've respected this bullish price action. So this area of bearish price action, this portion where it was bearish, because we formed lower high, this is a complex pullback. Because if I know I'm drawing a lot of lines, but try and follow. Impulse, complex pullback, impulse. Right? We are still in that bullish scenario. So as you can see, structure is telling us multiple things. So we can't just read it based on that. We need to have a bit more clarity, because now we can say, is this a complex pullback? Are we respecting bullish price action? Or did we have a minor breakdown and have bearish price action temporarily, which was switched to bullish, etc., etc.? It can get very overwhelming because now structure is not giving you a conclusive answer. So at that point, we're going to follow some rules. Okay, let's stay like this. So ignoring that structure stuff for now, what are we seeing right here? We have a distribution schematic with bearish movement after my UTAD, equal lows respected. So that becomes liquidity. Liquidity equals money. So if price is to come back up here, and it is to do so in a bullish manner, we can actually view it in two ways. We can now, because we are anticipating a sell, and we had this bearish price action, we can actually say impulse, complex pullback, continuation. Now, as you guys can see, this is where it gets complicated, because now we had the counter perspective was impulse, complex pullback, continuation. You don't really know which one to play now. You're getting complex pullbacks on both sides. Structure is mixed, and you can get a bit confused. So now what you need to do is ignore structure temporarily, because that's going to tell you different things. That multi-time frame analysis is going to tell you different directional biases. So what you need to do is, okay, ignore that for now and just follow the smart money and follow the schematic. This is where we added the rules, because as you can see now, when me, Alex, and Wally were trying to put this into play and we were trying to make it work, it's very complicated, because structure is telling you different things, price action is telling you different things, smart money, Wyckoff theory, they're all telling you different things, and you just get lost. So you need to say, what is my favorable outcome and what are the rules I need to follow to be able to trade effectively? So for a distribution, for us to take a setup, assuming a distribution, and for it to be valid for an entry, that's the criteria. For it to be valid for an entry, it can still be playing out, but it did not meet our criteria. So what we need to say is our criteria for entry is if the lows are sustained, equal lows are sustained. If we do not have a break of structure, because the break of structure, as that EA, CJ, I have another Euro USD example, I have plenty of examples. We have a break of structure. In my mind, that's a good thing. In reality, it's a bad thing. And when you backtest this, you're going to understand why. But let's just follow the rules for now. I want to see equal lows respected. So therefore, we consider this our impulse. Impulse after UTAD. We get some sort of bullish price action. That's fine. That bullish price action is simply to come to mitigate. And then we get impulses down. So this would be our test. LPSY. We'd get some sort of sign of weakness, and then you get the sell. Okay, that is the favorable scenario for a distribution. Now let's copy this. This is a valid distribution. Now I'm going to talk about okay. Now let's see, when everything is the same leading up to it, what would negate it for us for an entry for a sell? Let's get rid of all of that actually. Actually, before I move on to the reaccumulation stuff, regarding this distribution stuff that I've just covered, did all of that follow? Did all of that make sense? Because again, it's stuff we spoke about last week. So hopefully it does. I'll explain why a break of structure is a bad thing. Potentially late to the party, yes, Alex, but it's more to do with the shakeout perspective, which I'll teach in a minute. Equal lows respected equals distribution, correct. That's kind of what we want to see as a criteria. Which time frame? Every single time frame. You're going to see this on the 1 hour. You're also going to see it on the 1 minute. Time frame is not an issue. The equal lows are necessary. Yes. Explain it. Equal lows broke equals accumulation. I'll explain. But you're kind of on the right lines. But yeah, the distribution stuff is everything we spoke about before. And remember, for this to be valid, it has to be in a supply zone. What do I mean by that? Supply zone equals IFC. It needs to be an institutionally funded candle on a certain time frame. That would define for us a supply zone, preferably if it's something like this. if we had something like this where bearish price action was coming from, then we know that this was IFC and supply zone, and it was with intent because we had a break in structure. So if price comes back here, this is just not to do with Wyckoff theory. This is just normal price action in smart money. This would be a valid supply zone. Sorry, that's terrible writing, but you know it's a supply zone because we had an IFC that led to a break in structure. Therefore, if price comes back, we are likely to see a mitigation. That is a valid supply zone criteria. Inside the supply zone over here, we would like to see a lower time frame distribution. That's what I was explaining. And why does that make sense? Because in the past, this was a price reversal point. Price came here and then reversed. Therefore, if price comes back here again, we can anticipate it again to reverse if we are following bearish structure. That would make sense. So that's kind of the theory behind the supply zone. But let's move on to reaccumulation. Okay, now we have the exact same scenario. At this point, you would be logical to be thinking, for a distribution for the sell because you have no reason to believe otherwise. If you're in a valid supply zone, you have no reason to think this is reaccumulating from the information we have at this point. Right now, we do not have enough conclusive information. Okay. Now, moving forward, we need to discuss what would negate my distribution and indicate to me we have started to reaccumulate. Impulse or correction at this point, we don't know, because this could be impulse correction. We could be continuing up. That is valid. Or this could be impulse correction continuation. At this point, we don't know. So we follow price action and see what it does. Price comes back and does this. So we formed relative to here, still a higher high. We are still bullish. But now we do this. Lower high, break my previous higher high. And now technically we've had a break of structure here. Now, of course, as I mentioned before, this can be part of impulse. So we can have bearish price action. That's normal. But this is what I want everyone to follow. If price is here, we formed equal lows, sustained. So therefore, we can anticipate that. That still makes sense. This is where it changes. Break of structure here relative to this equal low, but also we have had a break of structure of my range. We've had a full break of structure of my schematic. Now, this is again where you can think, okay, if I was looking at my IFC on the 1 hour, it is not mitigated. But if I was to look at the 4 hour, you could say this is mitigated. And it mitigated my 4 hour IFC. That's where it can get confusing. That's where I was going wrong initially, thinking, okay, we've had a mitigation. This becomes my next IFC following order flow. Do I enter like this? Or do I wait for it to come up, still enter here? And that's where I started to trade distribution wrong. And you can actually backtest that because I've left those trades on my public Telegram. But this is what I learned in the process, or we learned in the process. What you need to be doing is dividing your schematic in half. Divide it in two parts. So this can either be after your UT or after your UTAD, because not always you will have a UTAD. You might have 1, 2, 3 drives, or you might have preliminary supply, buying climax, UT, UTAD. Both are valid. So depending on the circumstance, you divide it accordingly, depending on what has presented. But the whole idea is you want to divide your schematic into two pieces. And if it is a distribution, again, divide it in half. If it is a distribution, your first half will look like a distribution. It will follow suit of a distribution. Your second half will also look like a distribution. It will not really give you a real reason to doubt it, apart from the complex pullback stuff which I was covering. But in general, when you zoom out and look at it, you will simply have your point of interest, UTAD or FU candle, depending on what place you're looking at it from, with your AR as the base of your range from a schematic perspective, or from a smart money perspective, equal lows which are respected, becoming a liquidity target. Everything makes sense for the sell. Now, when we come to reaccumulation and you divide it into two, in the first half, you will see in the first half, you're going to see distribution. You're going to see all of the signs of what a distribution from a schematic point of view will say, and also from a smart money perspective can be valid as well. That does not negate it if you see equal highs in FU, but it's not a necessity. But the differentiation comes as the second half will actually look like an accumulation. This is the differentiating factor. And now this is not something that is taught in smart money. This is not something that is taught in Wyckoff theory. In general, I don't think this is taught at all. This is something we created as a rule for ourselves because we noticed its tendencies. Now, before I go into the rules, I'm going to talk about the logic. When I was talking over here about this diagram, we were saying that consolidation, when price is moving horizontally, that is simply buyers and sellers interacting, because sellers are coming into the market because it's a high price point and buyers are taking profits, so leaving the market. So therefore you get some sort of interaction. But if buyers still want to be in control, if demand, like I've written here, if demand is converted into further demand, what is going to happen? That interaction is going to lead to bullish price action. So when you are consolidating, at the beginning of the consolidation, nobody knows, the market does not know, nobody knows at the beginning who is going to win. That's the whole point of the interaction, because supply and demand have reached an equilibrium. They have equal strength. So the market is temporarily going to stop moving in one direction. It's going to stop moving bullish, or it's going to stop moving bearish, and it's going to come to a consolidation or pause. That is because nobody knows who's in control. And simply the manifestation of a distribution is telling us that sellers were in control. And the manifestation of a reaccumulation is simply telling us that buyers were in control. So essentially the consolidation phase is the market interacting to see who has control. And we can only see that as the interaction plays out. At the beginning point, nobody knows who's going to win that battle. At the end point, you have the winner of that battle. So that is kind of the logic behind it, which is why we divide it into two halves. Because in the first half, logically, if I'm just going to show only the first half, what is logically happening here? As I've discussed, we've come from a bullish scenario. Sellers are coming into the market. Buyers are leaving the market. Why? Because buyers are taking profit and sellers are coming because it's a higher price point. They have scope for profit. So of course, you're going to see the distribution and the distribution kind of nature. In the beginning half, of course, sellers are going to be in control because buyers are leaving and sellers are coming. That's normal. But if the buyers decide that they're in control, what do they need to do? They need to convert that supply, the supply of the distribution, or I'm going to say in quotation marks, that supply that is coming into the market or potentially distributing. If buyers want to remain in control, they have to pick up those orders. They have to get rid of those orders. And what is that analogous to? Let's think of this as sellers. Sellers are coming into the market. Buyers want to be in control. Where have we seen that scenario before, where we see sellers coming into the market and buyers want to be in control? Supply. Where have we seen that parable before? We've discussed it on day 2, where supply is converted into demand. That is simply an accumulation, right? Sorry. Now, accumulation is usually a bearish market turning into a bullish market, but that's not the definition really. What accumulation is actually doing is turning supply into demand. So if we see that over here, this area, even though it is not a bearish market, we're actually in a bullish market because price was moving in a bullish manner. We are still now turning that bullish market into supply. I hope you guys are following what I mean by that. Even though we're in a bullish trending market, because sellers were coming into the market at that point, there is newfound supply. And we want to convert, if buyers are in control, they need to convert that same supply into demand. Let me just check if everyone follows what I mean by that. Cool. That's good. So just because we're in a bearish market, I'm trying to demonstrate the fact that in a bullish market, price is moving up. In that bullish market, we can still have supply from people coming into the market as sellers because of the higher price points. It does not necessarily need to be a bearish market because those sellers are going to start to distribute to put in those sell orders to take over demand. Therefore, if we are distributing or if we are reaccumulating, it's going to start in the same way because logically to me, that makes sense. Sellers are coming into the market. They're going to do what sellers do. And at the beginning, in the first half, the sellers don't know if they're going to win or lose. And the buyers don't know if they're going to win or lose. The whole point of a schematic is it's an interaction between the both to see who is in control. So naturally, in the beginning, you're not going to know who's in control. Therefore, you divide it into two pieces. That's what I found works. And what is the dividing factor or the differentiating factor is the actual breaking structure itself. The break-in structure, which previously would say it's a good thing because we've had a bearish break of structure, so we can anticipate that sell even more, has now become a negative. Why? Because that break-in structure took out my liquidity target. So now that liquidity target does not exist anymore. And what was it actually? Say, for example, we're here right now. If we read it from an accumulation perspective, we have selling climax, selling test, spring. And if we were following this from an accumulation perspective, selling climax, selling test, spring, what have we learned from that or seen many times? After your spring, you have IFC formed, test, bullish. That is what a reaccumulation is going to look like. Imagine you have taken a distribution and attached it to an accumulation, and together, when those are attached, that equals reaccumulation. That is what I have found, or we have found, sorry. That is what we have found to be a tradable example of a reaccumulation. You want to see a break of structure, and that break of structure, from a reaccumulation perspective. Equals, or is called shakeout. Now, this concept of a shakeout is not taught on everywhere on Wyckoff. You're going to find it some places, and in other places, you're never going to hear of it. So this is something that is probably not very well understood, but I think following that logic and following that thought process we have, that makes sense because now we are seeing buyers and sellers interacting, the spring or the shakeout, which serve the same purpose. We discussed it on day 2 in the Wyckoff block. What does the spring or shakeout do? The purpose of a spring or shakeout is to induce certain people and remove other people, as we discussed. You'll have it in your notes. The spring is a definitive point in an accumulation because that sees if there's any supply in place. Let's actually draw it out just for your clarity. If we are seeing an accumulation, that spring that's happened here, that has induced sellers. Why? Because the sellers have seen bearish break-in structure. They're going to be looking for a test continuation. That's what it does to sellers. It induces sellers. What does it do for weak-handed buyers, as we discussed as well? Buyers might enter here in the market, but only be wanting to take profit here. So they don't have a long-term projection. If they take profit, they equal sellers. So for institutions who are accumulating, that becomes resistance. So rather than having resistance later on, what they will do is instead have a spring, take their stop losses out so that these people don't exist anymore. The weak-handed buyers don't exist anymore. And when price goes up like this, we have taken out the weak-handed buyers. We have also taken out the sellers. So who is left in the market? Only the buyers who are accumulating, only the buyers that have the intent of accumulation. That is the purpose of a spring, and therefore the shakeout over here, therefore the shakeout in a reaccumulation serves the same purpose. That break-in structure that we see is not a bearish sign, because if it was a bearish sign, you're caught out with these people who are making a mistake. Those sellers. That is the differentiation. You could see this as a break of structure relative to here. This is my break of structure. Or you can see it as a spring, because you notice it's like this. And this is your mitigation area. So it's simply a misunderstanding that a lot of people have, including ourselves, that we realize that the break of structure does not necessarily mean it is a bearish sign. That break of structure could technically be a shakeout or a spring, which is a bullish sign in this case. So for us to trade the reaccumulation, before I move on, does that all make sense? There's a lot of information, but I hope everyone's following. Does the shakeouts have to be into a possible IFC2? Preferably yes, but it doesn't have to, because you have to realize the whole point of that break of structure spring is to clear liquidity. Now, if it conveniently mitigates something on the 5-minute time frame, it probably will, but it is not a requirement. You just need to see taking out of those equal lows. So equal lows FU to the downside, which in other words is break of structure from a price action perspective, or from a Wyckoff perspective, it's a shakeout. Multiple things telling you the same thing. Okay, no. For the people that don't understand, ask me why. Okay, I'll try and do it very quickly again. We have a valid beginnings of a distribution. Now, you can read it from equal highs, FU candle, or you can read it from the nature of the distribution itself with the buying climax, UT, UTAD. Either is fine. And you want to be seeing a common base points defined by where the AR is going to be. Your AR is actually going to be after your buying climax, at least to your AR. That AR, automatic rally, is going to define the bottom of your range. And if you see some sort of equal lows over there, that is a good sign that you're distributing. Okay, now it doesn't need to be a UTAD. It can simply be a UT. It doesn't matter. It drives leading up to it. But what you want to be seeing is, as you're coming down, you have a break of structure. That break of structure is, in our minds, a bearish sign. Why? Because it's bearish break of structure. But following the logic of Wyckoff theory, what is a break of structure? Looking at it from an accumulation. This point right here to this point right here, we broke structure. We had a bearish break in structure. But from Wyckoff perspective, if it's a spring, which bearing in mind is a break of structure, that is a bearish sign. The whole idea of the spring is what? Is to take out they want to take out weak-handed buyers, because when price comes down like this, their stop losses are taken out. So weak-handed buyers are gone. And what does it do to sellers? Those sellers see impulse, correction, continuation. We see a bearish break of structure. They are going to be wanting to do that. They are going to be wanting to sell on a lower high lower low perspective, looking for bearish continuation. Sellers are also induced into the market. So when you have the real spring over here, and then you have this, and then it comes up here, and then you have your test. We have taken out the people that were selling. People that were selling here to do that, their stop losses are here. So when you have that spring, their stop losses are taken out, and then you have that test, which is a mitigation of IFC to continue up. So now you can see that a break of structure does not necessarily mean it's a bearish sign, because if it is people who are accumulating, it is a trap. You're taking out the weak-handed buyers, you're taking out the sellers, and the only people that are remaining is the people who are accumulating. That is the same as a FU candle. What does the FU candle do? It takes out sellers, induces buyers, and takes them out too. That's why it's called a FU candle, because it's a FU to both buyers and sellers, and the only people that win is the institutions. Same here. Buyers are taken out, sellers are taken out, and after the spring, the only people that win is the people who are accumulating. So that break of structure, therefore, can be a point of confusion. It is a point where things are not definitive. As opposed to thinking it's a positive thing, we have to now appreciate that is a point of confusion. So what we do is, once we've seen that break of structure, we're going to say, okay, let's analyze this again, because that is a change now. That is a change that is not favorable to us. Let's reanalyze the situation, because up until here, the distribution was valid. The distribution was still valid. It was the break of structure itself which took out the equal lows that added some sort of confusion. So now we need to reanalyze after the break of structure and say, okay, are we seeing after the division, do we see why can we consider that a valid play? Because we have equal high targets, and this is relative to this area. This is all an FU candle. What do we know about FU candles? They are more likely to be IFCs, therefore they require mitigations. So therefore we can see that bullish scenario playing out. So simply, a reaccumulation is distribution and accumulation joined together. Now, for us to trade this is where especially on the lower time frame, it's very sensitive. Things are moving fast. You're going to be getting confused because it's the 1 minute time frame, and it might be a not conclusive break of structure. It's just going to be ambiguous. So what can you do in those situations? In this situation, what I would do is I'd see this break of structure, and therefore as a shakeout or a spring or a FU candle, they're all the same thing. Enter the buy over here with 1% risk. Now, if this is my zone of risk, this is all my zone of reward. So I know my risk reward is fine. When price comes all the way up here, and this is my UTAD area. When price comes over here, I can do my momentum trend line, see if there is validity on a momentum trend line play, entering like that, and entering the sell. Because as I discussed earlier, just because, I want to see if I still have the diagram. Yeah, right here. I know it's a bit chaotic, but yeah, I'm sure you all remember. Just because we had a momentum trend line and rejection of a UTAD, that does not mean it invalidates bullish price action. That bullish price action can still happen after a rejection and a momentum trend line break on my UTAD area. That is still possible. Why is that still possible? Because that is simply a mitigation for reversal. Sorry, that is simply a mitigation for a retracement, but not a reversal. I'll say that again. That momentum trend line break is a mitigation that is simply designed to be a retracement, not a reversal. So you can have a break of the momentum trend line. You can have price moving down, but that can simply be as part of a retracement to continue to be bullish. That's why you can have both scenarios playing out. So when we come back to a reaccumulation, what you can actually do is, over here, you can enter with 1% risk on the buy, and then on this momentum trend line area, you can also enter with 1% risk. This one will be break even at this point, so you're covered. And this one, very quickly, you can break even because it's a very narrow stop loss because you're doing it on the momentum trend line. So this will be, actually, let's do it like this. Break even, break even. Now what you've essentially done is, whatever the market does now, if it does this to respect bullish price action, it continues up, your break even is going to go, that's going to leave, and you're going to remain with the buy. And if you misread it for whatever, and it was actually not a reaccumulation, it was actually a distribution as you might have thought in the beginning, then this one is going to hit break even, and this is going to be the one that remains. So you trapped the market, you hedged in both scenarios because both made sense. The risk reward was justified on both sides, and that is the kind of combination of devil's advocate. Because if you're in a zone of confusion, you just do the intelligent things. You follow the concepts we have taught you. You consider all the variables. You consider all the factors. And if it is valid for an entry and the risk reward is justified, you just do this devil advocate's play. You can enter on both. You'll take a 1% loss for sure. Or sorry, not for sure. You're going to hit break even on one for sure. You might hit stop loss if you didn't break even. But you know that your risk reward will still justify it on an overall basis. Hopefully all of that made sense. If it doesn't make sense now, because I don't want to spend too long on this segment, because I imagine a lot of you will not be doing this in the beginning because it's kind of a complex thing to do. Maybe in the next 6 months you'll get a hang of it, but I don't imagine anybody doing this in the beginning, so I don't want to linger on this topic too much. Cool, it makes sense. Nice. Yeah, I'll show you some examples. My CAD JPY trade, which was the 1 to 150 risk reward trade, was based on exactly this. We were inside a spring on a higher time frame, so I was looking for buys, but I was seeing a distribution, so I was a bit confused. A distribution on the 1 minute. I'll show you guys later on. So I was trying to battle: do I look for a buy? Do I look for a sell? We had a break of structure. Now I'm confused. Is that a break of structure for the sell, or is that a spring for the buy? Very confusing. So what do? You trade both, and in the end, that was a phenomenal trade. So you trap the market in a sensible way. It's not a risky thing to do because everything I've explained so far is justified and the risk reward is justified. I have a 2-hour EG chart. Probably do. I just don't remember which one you're referring to. Today we will discuss trades that have reasons to discuss them, meaning you will learn something from the teachings we're shown over the last 3 days. The examples we will discuss is derived from those factors. So actually, I've been talking for too long, so what I'm going to do is, it's 39 right now. Do you guys want a break or just a quick one, 5-10 minutes? Yes, no. Okay, I'll give you guys a break. Let's do, let's come back at 45 minutes past the hour, so a 6-minute break.
What was this? The not the advanced concepts too. The what would you call this block, if you mind me asking?
To be honest, we give a syllabus of blocks and everything like that, but our sessions are just freestyle from what makes sense.
Okay.
From the basic flow. So none of us are really following what the syllabus is, but everything in the syllabus will be covered. Maybe just not in the order that is stated. But this is actually let's say Advance Wyckoff.
Advanced Wyckoff. Okay, thank you very much. Appreciate it.
Okay. I'm gonna go quickly to get a drink as well. So give me 5 minutes.